at 8:32.
I apologize for the 2 minutes. It was my car's fault.
We needed the extra time to
Okay.
discuss that.
It was out there talking to me, but at least it didn't sing. When it sings, none of us would be able to sing.
Okay, so Leland, would you lead us in the pledge of allegiance?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
You guys are pledging allegiance to a corner.
See if that's something wrong with that.
We know the
Okay, the first item is the consent agenda, the minutes, the retirement report, preliminary monthly financial report for April and for May. And is there any discussion regarding the consent agenda? None? Okay, I don't think we're gonna need a motion. We'll move
By
on.
unanimous consent, the
Yeah.
consent agenda can be adopted.
Okay. Discussion and possible action regarding investment matters.
Claire, you're up.
Is this the private infrastructure?
We're going to talk about infrastructure, private equity, and private debt, private real estate debt. All right, Claire,
Great.
thanks for joining us. If
Thank
you'd
you for having
introduce all of your support and backup you brought with us today, brought with you today.
Absolutely, yes.
We appreciate it. And then we've all got the presentation, and we'll just fire away.
Perfect. So you get to hear less from me and more from the experts today. So as kind of background, why are we here? What are we doing? Jan Mendy is here with me. She is part of our Real Assets group, Real Assets Consulting. So she's going to talk specifically about infrastructure and real estate debt. And then Gary Robertson is here. He's a member of our private equity consulting team. So he'll speak specifically to private equity. So as you all know, we're gearing up. We're working on the asset liability study. And as part of that process, we started a couple months ago. We were here talking about other asset categories that you could consider including in that study. So outside of public equity, public fixed income, and real estate, what else do public plans invest in and that you don't currently invest in? Do you want to consider any of those asset classes, and which ones should we be including as components in the asset liability study? So in our last discussion, we talked about a whole broad range of other asset categories and narrowed it down to infrastructure, private equity, and real estate debt as categories that we want to talk more about. So as it stands today, our understanding is that you still want to include infrastructure as an input into the study. So we'll include that in the mixes. We've talked about including, doing mixes with and without private equity. So not necessarily locking down that as a sure component of the future asset allocation, but at least looking further into it, modeling it into the portfolio, what would that look like? And then real estate debt is more of an implementation consideration. So we're going to talk more about it today, but we will address that later once the broader asset allocation is set. So whether that, if there's a decision to implement real estate debt, that could come out of a piece of the real estate portfolio or potentially the fixed income portfolio, but that's more of an implementation consideration. Because when we think about the broad asset categories and the inputs that we need to model it, we don't actually have a separate one for real estate debt, so we can't model that in. The other two we can. Why are you considering including new asset categories? One thing that this board has talked about for many years is that the majority of your plan is in public markets, so public equity, US and international public fixed income. And that's been really successful. It's worked out very well. But there are good reasons to consider other opportunity sets. It is one thing that makes you different than some of your peers. A lot of other public plans include private equity or real assets that provide a differentiated return stream, that are different opportunity sets for investment. And so when we look at your performance versus a peer group, you tend to be the top dot or the bottom dot. You've been the top dot for a good long time, but I think it is a good time to consider potentially diversifying that return stream. Taking back about a year ago, in August of last year, you had a large discussion about how to potentially diversify your real assets component. So you do have the two core open-end real estate funds, but what are ways that you could potentially diversify that? That's where the infrastructure discussion came in. So that's mostly just background. Why are we here? What are we talking about? What do we expect to get out of this meeting? No decisions have to be made at this meeting. Our understanding is that this will be largely just discussion-based. Future discussions will build on this as we move through the asset liability work. But if there are any stronger reactions to change the course of including infrastructure in the modeling, or not looking at private equity, or potentially looking only at mixes that include private equity, we can certainly move in that direction as well. But our baseline is that no decisions do need to be made today. So if there are no questions, I'll turn over to our experts. Jan's going to start with discussion of infrastructure and then real estate debt, and then we'll pass it to Gary for private equity.
Great, thanks Claire. Thank you for having me at your meeting today. I've been at Callan 2 years, but I've been working with pension funds longer than that who have been investing in infrastructure. So I enjoy getting to get out and talk to people about the asset class. So I've prepared a deck here with just some high-level information here, and feel free to ask questions. I invite that. So in terms of just explaining what infrastructure is as an investment, in the deck here on slide 3, some people define infrastructure as an asset that facilitates movement of people, goods, and ideas, and essential for the economic productivity of a society. So really, what does that mean on a practical basis? Infrastructure assets are grouped into transport, utilities, communication. Renewable energy has sort of emerged as a subclass that used to maybe be part of energy, but it's gaining more ground. Water and waste, and then traditional energy is a subclass as well. So under all of those groups, you see specific types of assets that an infrastructure manager might invest in that are common in the private market side. On the right side of this page here, there's a category social infrastructure. And honestly, most of the social infrastructure investments have been done outside of the US, just because financing mechanisms outside the US require more private capital to invest. Educational facilities, medical, public transportation. In the US though, we're starting to see a little bit of change there as municipalities are looking more to partner with private capital, but it's a smaller part of the opportunity set in the US to date. Slide 4, what's driving the demand for global infrastructure investment today? And on the left, I have the different sectors, energy, power, transport, but within the US, with all of the oil and shale discoveries in the past few years, there's a lot of demand to move those assets from where they're found to where people need them. In the power side, people are more and more concerned about reducing carbon emissions. And so there's a trend to have more wind or solar or hydro. Biomass is kind of out there as well, but not as widely an opportunity, I would say. On the transport side, in the US, we've had problems with roads and things breaking down essentially that need to be reinvested in. There's been a different adoption of that kind of municipal reinvestment across the US. Maybe we'll see more of that in the future. That hasn't been a huge source of opportunity to date for the private investment funds. Maybe that will change. On the communication side, everybody has a cell phone. Everybody's ordering things off of Amazon. The amount of data that's being pinged around on those towers is just increasing exponentially. So there's demand for more towers, better broadband. Those are types of investments people might make. And then water. The water utilities in the US, they're pretty small and they're pretty scattered. A lot of them were built a long time ago, and I've seen infrastructure managers talk about how they've gone in and invested in a water system, and they've had pipes that have been corroding. They put sensors on those pipes to detect leaks so that the system runs better, it's more efficient. So those are types of things infrastructure managers are doing. And then lastly, on the social infrastructure side, there's less of this type of investment in the US because municipal bond financing has been so attractive. That's how a lot of that investment gets done, and it doesn't require private infrastructure investors. That being said, one of the infrastructure managers has, I think it's a 30-year agreement with the state of New York to build a new bridge and operate it there. So there are different types of things happening in the US which could be model for future investment. So those are kind of what's happening real time. This next slide here, I think Claire and Greg had this in the prior deck comparing listed infrastructure, which is the publicly traded infrastructure investments, with unlisted infrastructure, which is private investment. It's a little confusing to talk about publicly traded and public infra. So we sometimes talk about listed as the public markets and unlisted as the private markets. So it's usually a little murky in the conversation, but just wanted to put this slide up for you again to show you the difference between the two. Today we're going to talk more about private infrastructure, and these are investments in specific assets like airports, water systems, electric utilities that the private managers invest in and intend to hold for a long time. Because those assets are stable, they expect to get steady cash flow out of those assets, and that's a key reason people are looking at infrastructure as an investment opportunity these days. There are some strengths and weaknesses on these pages. On the private side, as I mentioned, durable cash flows, but a weakness is assembling a diverse portfolio so that your portfolio may have 15 or more investments in it so that any one investment doesn't determine your whole portfolio's outcome. So that's a challenge for infrastructure managers. It's a newer asset class. The portfolios are smaller now, but they're raising more capital. They will get bigger over time. The next page here, a little bit of a diversion, but just in case you were curious, if you invested in listed infrastructure, what would you get? The left pie is about 50% of that exposure is in the US. The right pie is by sector. And you'll see that most of the sector opportunity is electricity, integrated electric utilities, regulated utilities, or midstream utilities. So if you invest in infrastructure in the public markets, it's mainly energy. So the reason people look at private infrastructure is to get more access to transportation, communication, and other sectors. So the next section here is infrastructure as an investment. So why are investors looking at infrastructure? Long-lived assets with defensive income streams are the key reason people are looking at this type of investment. The typical sectors, as we've covered, is energy, renewables, water, transport, communications. The private infrastructure managers are mainly investing in, you'll hear the term OECD, Organization for Economic Cooperation and Development, the major markets. So not fringe markets or small countries, tends to be the larger, more stable economies. One thing that's interesting about infrastructure here, the private infrastructure funds tend to be global. They're not only focused on the US. So if you're investing with these funds, you have the potential to add some global exposure to your real asset investments. Right now you have the open-end real estate funds, which are 100% focused on the US. So that's a benefit, potentially for an investor in their portfolio. Everything's not perfect though, right? So some of the risks are these assets may become less defensive as consumer demand changes, or as regulation changes, or as the competitive landscape changes. One example of this in the past year and a half is investors thought the UK water sector was a very safe investment because it's been around a while. Everybody needs water, whether or not Brexit happens. But the UK government there, especially the water regulator, has been getting more populist in trying to reduce the profit investors can make by owning those assets. That has impacted the value of those assets as of now. These are long-term investments that may change, but that's a pressure on that particular part of the industry. Another risk is that if interest rates really start to increase, that could impact the value of these assets. Infrastructure assets generally have more leverage than real estate assets. Your core real estate funds, the leverage there is 30% or less, I believe. Infrastructure funds probably have 30% or more. Some of them may have 50% leverage. So as interest rates move, that could impact this asset class. And then lastly, part of the benefit of these open-end infrastructure funds is your global exposure, but with that comes foreign exchange volatility, which over the long term is, may normalize. Some people think that the dollar may be strong now, but it may not be as strong in the future. So if you have investments outside the US, that's another way to diversify your portfolio exposure. So those are some of the key risks and benefits to invest in infrastructure. Next slide here is the infrastructure fundraising graphic. And I think it's interesting, infrastructure as an asset class really got started around 2006, 7, and 8. And you see fundraising there did well, and then the financial crisis happened and everybody stopped looking at new things. They were just focusing on managing their portfolio. So since then, you've seen the infrastructure fundraising numbers increase, and investors have been increasing their allocations to infrastructure. When I worked in Europe, it was more common for investors to have a 5% or even higher allocation to infrastructure. In the US, I'd say 15 to 20% of investors have an infrastructure allocation now. And that could be 0 as an opportunistic thing, or maybe 5% at the higher end. So,
And is that mostly public pension plans or pension plans in general, other investors?
I'd say a lot of public pension plans are really looking at the space right now. That's why I work mainly with public pension plans. So on the corporate side, they may be doing more energy type of things just based on their history, but I think everybody's looking at infrastructure as a way to add a different element to their portfolio. So the range right now is sort of 0 to 5%. We can see that growing over the next few years as people look for, just like you, ways to sort of get out of public market and build more sort of defensive income streams. And the next page here is the most exciting pictures of infrastructure assets that I can find. Yep. On the left side there, that's your cell phone tower. It's a hard asset. It has a long life. And is providing everybody the way to see if their pings from here to there. The asset on the top right corner is a water desalination plant that was built in San Diego, California, in Carlsbad. I don't know if any of you have ever driven on the freeway, but you've probably seen it. You've seen it? Yeah. And this plant is pretty monopolistic in that it was hard to get this plant approved, it was hard to build it, and it's not easily replicable. Also in Southern California, they need water, so it was pretty important. So high barriers to entry, low demand elasticity. The owner of this plant built it, and as they were doing that, they secured a 30-year contract with the San Diego Water Authority to provide them water at a fixed price. So the owner of the plant knew their income stream, the Water Authority knew that they would get water. So it was kind of a mutual benefit for both. The bottom right picture here, I don't know if you know what it is. Any guesses? Yeah, no.
Golden Gate Bridge.
A ride at Disneyland.
It's street lighting. This is an investment that's more common in the UK, where certain municipalities said, we don't want to maintain our street lights. We want some private investor to do it for us, and we get a known line item on our budget, and they manage it on a day-to-day basis. So we've seen more of that outside the US. But the operator of this particular asset has a known income stream as long as they make sure those lights are on. They can't really do much with that asset, but because their contract is so rock solid with the municipality, they can often take out high leverage on it. So those are different ways that investors look at infrastructure assets. I know they're exciting, aren't they? Sure.
So are these fully amortized? You get your return of and return on your investment?
That's a good question. Solar, renewable leverage tends to be fully amortizing. So a solar asset may have a 25-year life, and your financing runs for 25 years and is fully paid back during that time. but other assets like a port are not gonna be fully amortized.
Is your investment fully paid back over that time as well?
Very good question too, that's the question I
Because
would ask.
these are depreciating assets.
Right, right. So in the case of sort of solar and wind assets, that's a question I like to ask managers because they may have an asset that is 25 years useful life. They may have a 20-year contract. So after that 20-year contract, are they putting any value on that asset? More and more managers are saying no. But some are still saying, no, I'm planning to recontract that asset for 5 or 10 years. And there they have to make a bet on what they think the power price is going to be at that time, what the competition is, and all of that. So for those types of assets like solar and wind that have a very finite life, that's a question to ask these managers. Airports are a little different because they, depends on the contract, if it's a fixed year contract or if they own that port, the land there, and the development opportunity around it and things like that, so.
We finance that, just as a side note, we financed the wind farm in Contra Costa County.
Yep.
They took out 50 windmills and they replaced them with 5 and got the same amount of power.
There's been big improvements in just like the length of the blades and things that people can do. And that's a thing question for renewables is, how will technology improve in the next 5 to 10 years? One thing people talk about is battery storage. During the day, you get a lot of wind, you get a lot of sun. But at 5 o'clock when we all leave our desk and go home and turn on all the lights, the sun's not out as much, the wind's not blowing, that puts a real load demand on the traditional power sources. And so if people can develop batteries to hold on to that daytime generated power longer, it helps the whole thesis for renewable investments, and that's something people are really talking about. Different states have different guidelines for achieving, renewable energy goals. So that's, that I think will change in the next 5 to 10 years. We'll probably have more batteries.
So if you invest in infrastructure, you're going to be investing through managers who have pools of these investments to diversify your risk. How do you get to pick? I mean, because any pool, whether it's a pool of mortgages or it's a pool of equities or it's a pool of infrastructure, it's the underlying collateral. So how do you get to look under the hood to see what your investment really is?
Sure. No, we have some slides here that are additional to the deck where I have laid out 6 different open-end, sort of perpetual private open-end infrastructure managers. And I've done a chart of geographically where are their assets located, US, Europe, Australia, other, and then I also have another chart of what kinds of assets they have in that portfolio. So to maybe answer your question of what am I actually getting? And so I don't know if you would just jump to that now, maybe. If we could just go to slide 11 in this book here real quick, and then let's jump to your portfolio question. So I think slide 11 is what Claire and Greg had presented before, different risk return of infrastructure assets. And if I can use the example of that water desalination plant in San Diego, that we did some research on it, and it was initially, the idea was conceived in 1998 as a public-private partnership where some private company would develop this water desalination to sell water to the San Diego water utility. It took until 2012, and another buyer bought it to complete the plans to develop the asset and actually start construction. It took 3 years to build that asset. Earlier this year, in 2019, almost 20 years after the initial plan, a third investor group bought it because it was an operating plant with a known history with a stable offtake contract, and it was bought by a core buyer. So you had the opportunistic buyer with a blank, piece of land and a dream. You had the second guy who had the permitted land, who had to build it and take some risk, and then you have the third guy who has an operational facility with a contract. So that's one asset that really shows the different types of risk you take with the same asset. And then maybe if we can jump to the secret pages there. We get this information from private managers, and we do a lot of conversations and data gathering, so I wanted to have the latest data to share with you here. And there's a page, open-end fund comparison, that has the 6 different private infrastructure strategies. If you look on the left side of that page, IFM started their fund back in 2004. The next one over is JP Morgan. They started their fund in 2007. So they have more than 10 years of operating history for those vehicles. The next line down is the net asset value. The IFM fund has about 22 billion of capital in that fund. The JP Morgan fund has about half of that. The IFM fund has 15 investments, the JP Morgan fund has 19. And then if you just look quickly over to the right side of the page, you'll see that the other 4 funds were started 2012 or later. And their fund sizes are significantly smaller than the JP Morgan and IFM fund. And they have fewer investments than JP Morgan and IFM. They're just newer. So in terms of a portfolio, IFM and JP Morgan have more investments, which means more diversification. So any one investment is gonna have less of an impact on the portfolio performance. The Blackstone fund was raised in 2018. It's very new. They only have 2 investments. So right now that you have to really believe in Blackstone and their strategy to sign up for that. They have raised somewhere around $7 to $10 billion of capital because they're known in the market. But right now their portfolio is pretty concentrated. So we'd like to see that develop a bit more so our investors know what they're going to get into. And then maybe if they have any questions, feel free to jump in. But I guess I'd say the 2 funds on the left have the most track record and most number of assets.
So one thing we talked about when we talked about infrastructure a couple months ago was that you kind of narrowed down into, you could go closed-end, you could go open-end from a fund perspective. If you go for a closed-end fund, you don't know what you're going to be investing in, right? You give them their money, you give them your money, and that gets locked up, it's illiquid, and they go out and you have to trust them to invest in assets that they believe in, and you're trusting them to do that. With an open-end fund, to your point, Lee, you should have a better visibility into what your money is going to be put to work in. But another thing we talked about is that the market within open-end infrastructure is still quite narrow. It's definitely growing, and a handful of the funds on the right side of this page are in that bucket. They're the newer funds, they're growing, they're gonna have a larger asset base, or a larger number of investments, I should say, but we're looking for them to become more diversified. So,
Yeah.
it's a newer, there are some newer funds around, and then there's also some that have a 10-year track record.
Yeah. And then I guess to Lee's question, if you turn the page over there, there's a page titled Summary Portfolio Composition for Open-End Funds. And the top table there gives you a sense of geographically where are their assets located. And you'll see, most of the funds have US exposure. The First State Fund doesn't have US exposure. That's because they got their start in Australia and they've slowly been expanding out of that. They'll be investing in the US. The Blackstone Fund is 40% US exposure. The reality is they haven't allocated the rest of their capital yet, but they are North America focused. Brookfield is going to invest globally. Their first asset, they only have 1 asset, is in the US. So you see that these funds here have the potential to give you some global exposure for the real assets portfolio. And then the bottom table there is the sector sort of summary by these different funds, so you can see what they're invested in. Maybe just starting at the top, IFM, they have a seaport terminal. Their terminal they have 2 actually. One is in Turkey, which has been in the news a bit, and the other one is in Poland. So they're in some, OECD markets, but those are not the UK or the US. So you're taking a bit more country risk, I would say honestly, with IFM. On their Turkish port, the contracts at that port are denominated in US dollars, which helps, but it's still in Turkey. You've seen Turkey in the news, right? Other investments that IFM had are water and waste investments in the UK, electric utility investments in US, gas distribution business. They own the Vienna airport, and they have a small investment in the pipeline industry here in the US, but they just announced that they are taking private in MLP Buckeye Partners later on this year, so they will have a big exposure to the US midstream sector by year end when that investment closes. And you can see the other sort of sector breakdown on this page here to maybe give you a bit more idea of what they're investing in.
You didn't mention the IFM toll road. What is that?
Sure. No, IFM has two different sort of toll road investments. One is the M6 toll road in the UK. I've never driven on it myself, but it's in sort of the Midlands area of the UK. Helps people get around there. The other investment is in Mexico, and they have a big toll road platform there. That was bought from the developer who developed those toll roads, and the developer built them, and then they brought in IFM to own part of it and get some liquidity. And some of that investment is availability based, where the toll road just needs to be open and operational, and then IFM gets money. It doesn't depend on how many people drive on the road. IFM also owns the Indiana toll road. Don't know if any of you have been on that here in the US, but it's a big thoroughfare for people, trucks going back and forth bringing goods through. So you're right, they do have a lot of toll road exposure, and it's something they're very conscious of, so I think they were actively looking for investments in other sectors.
Can you explain the difference between the total return target and target return, target income return?
Sure. That's on that open-end fund comparison page.
Yes.
So total return is, if you are invested in that fund over the long term, how much return can you expect on your capital? And the income return is how much on an annual basis you'll get. So your yield may be another way to say it. So IFM is targeting to give investors 6 to 8% return on their invested capital on an annual basis. So similar to your open-end real estate funds, you get some income or yield off of that, which a lot of pension funds like because it helps them meet current obligations, and it also kind of de-risks their investment. It puts the money back in their pocket.
So in order to get a higher target rate of return, they're looking at appreciation on the back end?
Exactly.
On a depreciating asset?
As they're owning these assets, they're also making different improvements to them. If it's a port investment, the land around the port will increase in value over time, and that's kind of part of the appreciation, things like that. But most of the return is coming from current income.
Yeah, how much weight do we put on that target return? It seems like there can be a fair amount of variability fund by fund to.
Yeah, on that point there's the third page, that's the fund performance comparison. And this is actual performance data from the funds that have been operating. And IFM last year had a 22% return. Their target return is 10%, so they really outperformed. What are the reasons for that? There's been a lot of demand for infrastructure assets, so just by holding assets, people are willing to pay more for them than they were 5 years ago, so they just benefited, like in real estate, from holding an asset that more people want and will pay more for. So I think their performance over the past, last year, last 3, last 5, last 7, has been above their target.
So it'd be like just a function of lower interest rate, lower cap rates?
Yeah, discount rates is what they use for valuing infrastructure assets, in terms of current value of present or future payments. So IFM has benefited from that. So their performance has been very strong. On a 10-year basis, their net performance has been just over 10%, which is closer to their long-term target. So their performance has been very strong the past 7 years, but so has every asset class. So, I think it's reasonable to expect that their performance will go back down to their target 10%, but other asset classes are in the same cycle. as well. And the JP Morgan fund, you can see last year, had a return of 4.7%, last 3, 6.6, last 5, 4.2. And I really looked at that to figure out what's the difference. Well, as you picked up, IFM has toll roads in Mexico. They have Turkish ports. They have a more different kind of global exposure. The JP Morgan fund has a significant amount, I believe it's over 20% in renewables. And the value of that renewable is kind of capped by how much value is in your contract, how long will that asset last. So the JP Morgan fund has a higher proportion of those super safe, I hate to say safe, but lower risk type of assets. So it's kind of going to anchor your portfolio here, which isn't necessarily a bad thing. It may motor along here, and IFM may do this. It's just a function of the portfolio construction.
And we've talked about, from an implementation standpoint, we think it would be reasonable for you to pick potentially 2 managers within an infrastructure allocation, just recognizing that, you know, the number of investments that they hold can be pretty concentrated, and having a bit of diversification or some additional diversification with that allocation would make sense. And I think with an allocation to infrastructure, you should have the capital to reasonably make 2 investments.
And there are 6 funds on this sort of summary page. I had meetings last week with 2 different fund managers who are launching products in this space. So there's a lot of people who are watching this and want to offer products. So the 2 that I took to last week, they have smaller portfolios, but they're growing, they're raising capital. Interestingly, in the news, I saw a headline last week, CalPERS made a $500 million commitment to the JP Morgan Infrastructure Fund. That's pretty significant. I feel that's a large investor who has a portfolio that's pretty diverse. Actually, I do work with CalPERS on their infrastructure portfolio. They have a lot of energy in their infrastructure, which is composed of traditional energy, gas-fired power plants, and solar and wind type players.
So these sound like private equity managers? I mean, are the fees similar?
So on the fees, you're leading me right through my presentation here. On page 12 of that initial big book there, these are private equity managers, private equity infrastructure managers. The open-end funds have management fees of 75 basis points to 125 basis points per annum on NAV. And infrastructure open-end funds have a performance fee. So if the manager does well, they get to share in some of that profit with you as an incentive to keep everybody working hard. These are tough assets to manage. They take a lot of work. Open-end real estate funds typically don't have a performance fee. And that's something that I give the infrastructure managers a hard time about when I can, just because our clients are used to these kind of funds without incentive fees. But these are, I would say, more operationally complex than real estate to manage, so I don't think it's totally out of line.
And running an airport's not like running an office building.
Yes, there's a lot going on. So the fees for the open-end funds on page 12 you see are lower than the closed-end fund fees. Part of the reason is these assets are that stabilized desalination plant, not one that's being built and has a lot more operational complexity. So,
Do you want to touch on liquidity?
yeah, liquidity. So these open-end funds are newer. The JP Morgan fund, if you go into it, has a 4-year lockup, which means if you try to get out within the first 4 years, they take they charge you for that privilege. And the other newer funds are like that as well, because they need people to stay in these funds to stick with them. And if you were to make an investment into the asset class, we want you to stay in it, for at least 5 years to, have that benefit for your portfolio. So I would say that's the difference with the real estate funds that have been around longer. They don't have as big of a lockup on them. But the infrastructure funds, you should plan to be in them for at least 5 years.
You talked about Brexit.
Mm-hmm.
Do you have any concerns that 3 of the top 4 have 19 to 23% in the UK?
Yep.
Do you have concerns with that not being resolved at this point?
No, I asked the manager those
Okay.
questions myself, yeah. The investments that JP Morgan has are in the water systems, so people need water.
Right.
So that one is not going anywhere. Another manager has investments in the electric distribution network, and so people need electricity. So that one is something that, you know, as long as people are in the UK, that service will have demand. And then the toll road up in the UK there as well. If trade slows down, maybe the toll road doesn't do as well, but people are still living in the UK and going to see their family or taking holidays and things. But it's a question I've asked the managers. There was a manager last week who had bought an investment in the UK. I said, did you get a good deal on that? Because fewer people are interested. And he said, well, there are fewer people looking at those assets now, so the competition's maybe not as intense as it used to be, but it's still at risk, yeah.
Are there minimum investment amount?
5 to 10 million. Yeah. But one interesting thing I'd say, IFM was founded in Australia by 27 pension funds, 20-something or more years ago, because they wanted to invest in infrastructure. So that's the genesis of that fund manager, and they've had a lot of different pension funds globally want to be a part of that, these assets. So the reason this fund is only in the Americas and Europe is they have a separate fund that's Australia only, because those pension funds started there, and then the pension fund said, let's invest outside of Australia. And so they've opened up the global fund to, you know, other investors as well. So that, I think that pretty much takes me through slide 13 there. It's just a summary of if you were to invest in North America only, open-end infrastructure funds. Right now, there are only 3 funds that would be able to, would fit your requirement there. 2 are equity funds, Blackstone and Ulico. 1 is a debt fund, which is newer, and I don't think it does the same thing for your portfolio, so I wouldn't even consider that. On the right side there, if you look at the open-end fund universe, there are 5 to 7 and more funds that would be, you know, potential to be considered as they grow in size. And in the US, the North America only funds, their bigger opportunity set is energy, so you could get a lot of energy if you went with one of those managers. But Blackstone is sponsoring a North America fund, and they're very conscious to build a diversified portfolio. Their current 2 investments, one is a midstream investment, the other is a port investment. So, yeah, that's one we're watching. It's still pretty new, I would say.
Any other questions on infrastructure? I think this is a topic that's been drawn out around this table for about a year. So our hope in this discussion was to put a little bit more context around, you know, what do these funds actually look like? You know, we've talked about it from the conceptual portfolio level. Why would you make an allocation? It is different than what you currently have and can provide some good diversification. But, you know, in implementation, you know, it's different than doing a small cap equity search. There's not the same broad universe of managers, and the way that we consider those managers is slightly different. So assuming that you move forward with this allocation, and again, we do plan to model it in, Jan would certainly be back here to talk more specifics about what managers we think would be good to consider implementing with, and the managers on this page would definitely be part of that discussion.
This was very informative.
Yeah.
Good,
Yeah, it
good.
was good.
Good. One other thing, just on that open-end summary page on the bottom there, you see there's a line fundraising status, and it tells you how much additional capital they have people sign up for. And then the line below it is how long it would take to deploy that capital. Because these are private investments, they're lumpy. You can't just go out and deploy it in the market. So if you decided to invest in one of these funds and signed up all your paperwork, you might have to wait a year before they call your capital. Just depending on, some will be shorter, some will be longer. But it's a part of, you know, considering this.
I'm going to ask her back to the beginning
Sure.
question. In Vietnam, anytime a new house or business or whatever adds electricity, they hang another wire. So these poles, and it's an emerging markets question, but these poles have just sometimes hundreds of wires hanging to expand an electric utility. If we were to invest in infrastructure, electric utility for Vietnam, how would we get any money back?
I will say the bulk of the managers that I've seen are only focused on those OECD major markets. There are some managers who are investing in, I'll call it an emerging market. It depends on how the investment is made. If they agree with the government to say, look, we'll fix your electric grid and maintain it, and they agree with the government to get an annual payment or something like that, or if they go in and build it and then they hope they can sell it to a different buyer when they're done. That might be two ways that they could do it. We have some clients who unfortunately got into Indian infrastructure before we were involved in the story, and those investments have just been very challenged. There's been a lot of issues there. So some managers are doing energy in Africa, and there's a need for it and things like that, but it's a higher risk type of strategy, and those would probably be done in closed-end funds that have a 10-year life, that you invest money, maybe more like Gary's story here. It takes a long time to get the capital called, and you may not see your money back for 15 years or something like that. So yeah.
Seems there's a lot of stripes in this cake. You got projects that were typically funded through bond funding for government infrastructure projects, and those governments, their bond ratings have gone down, and so it's cheaper to pass it off to private industry to hold these assets, and they borrow on their strengths and their limited balance sheets. And then you got, all the way down to replacing water systems in little villages in the middle of Africa, where a group of, the three of us get together and we fund it to some contractor who puts it in, who rents it to the village. So you got the from one owning an airport to owning a water system in Namibia. So.
You have a variety of things. A manager came in and was telling me about their infrastructure investment at an airport. I said, can you tell me more? And they said, smart carts. That was in an infrastructure fund. And I was like, that's at an airport, but I don't know if I would consider that an infrastructure investment. So you have to watch the boundaries that people are pushing.
Are there any, can we ask the question, are there any fads here?
Any what?
Fads.
The whole thing. To some extent, right?
Right, how do we create new investments
Yes.
such that we can seek yield in the first 5 years?
Yeah, and I think, so JP Morgan, with their open-end infrastructure fund, they just announced that they are buying the El Paso Electric Utility, which was a public company. So some of it, it's not a fad, but right now, some of these private infrastructure managers are taking things private. And the reason they're justifying it is that to be a public company, you have a lot of obligations, a lot of costs. So by taking these long-term assets out of the public market into the private market where you can do more long-term investment and aren't as focused on quarterly earnings things, is that a fad or is that just a...
Are these guys circling PG&E?
Oh, yeah, no, we have some, I've talked to infrastructure managers about that too, and that's a very tough discussion because you don't want, people lost their homes here and we need, how is that going to be resolved? So that's a very, very tough.
How's that risk going to be spread ultimately?
Yeah, will the PG&E...
We're all going to pay that bill.
Yes, we are.
Will PG&E contracts be honored with infrastructure managers who had contracted to do certain things, right? There's lots of people around with different tables on that one. But one thing that I heard last week, I guess PG&E shut off transmission lines in the past week. I don't know if you were impacted.
Well, they may do that here over the course of the next several months.
During the summer heat.
Yes,
Yeah.
red flag warning that's going down supposedly, yeah.
And so, those communities don't have electricity during that time, so maybe there needs to be a different way for them to have a source of electricity sort of off the grid.
Generators. Yeah.
It's their own district heating or district, utilities where this contained unit can provide its own energy through a combination of renewables or other types of technologies where they're not relying on the grid. So we're seeing lots of different ways people are looking at the space. So fads, public to private. I think years ago people used to talk more about biomass energy. I haven't heard as much about that recently. One poor manager was supposed to export wood pellets to Europe so the Europeans could burn wood because it was cleaner. Never mind the fact that they had to ship the wood all the way across the Atlantic. That didn't work out for them so well in 2000. So there's different things people try.
There's actually wood pellet stove here just north of you.
Yeah, so some of it can work, but some of it is difficult depending on what's happening.
Jan, anytime I see a queue to get into the investments, my warning flag goes up. If we're talking about doing this and there's already a queue, are we part of the herd going into this? And in one of your slides, we saw that increase in fundraising and the number of funds there. But I'm not convinced, I just don't know. Is the queue and the increase in fundraising and funds and infrastructure, is it reaching a point where there's a correction coming? Or is it just still so new, even though it's been around for a long time in Australia? Is it new to the US and still we're going to see continuing increasing? I mean, what's your thoughts there? I mean, there's a limit on the number of projects that are available.
Right, so one thing that we need to be sure of when we're doing manager due diligence is that we do trust the managers that, we would put forward to not just create opportunities because they have money they need to put to work, right?
Right.
Yeah, on the queue, allocations in the US are behind what they are in Europe. I've been at different infrastructure meetings this spring and I'm seeing more investors from Asia coming because they are looking to invest in this sector as well. So I think overall there's a high level of interest. Many people are below their allocation in infrastructure because it's a newer allocation. So I think over the next certainly 5+ maybe in 10 years, you'll see a lot of people coming into the sector, and that may drive prices up. That has happened. Renewable investments now, maybe like a 5% return, or you could get maybe a 10%. But there's so much demand, people are paying more, it's pushing returns down. But if you believe some of these assets have irreplaceable infrastructure, ports, airports, things like that, that will never go out of fashion, there's always a reason to hold it. So you have to look at the types of portfolios that managers are assembling. That water desalination plant I keep talking about, right? It went through at least 3 different sets of owners, all with a different purpose. Right now, JFK Airport, Terminal 1 is having a big redevelopment project, and private infrastructure managers are participating in that project to develop it, and then after that.
That's a total repositioning.
I believe it's like a 30-year contract, and there are 4 airlines that own the terminal, and the private managers have said to the airlines, look, we'll redevelop this terminal for you, and we'll get income off it for the next 30 years. So this first group of investors will go in, redevelop the terminal. Hopefully it happens according to plan and is done in 3 to 5 years. There's already delays. And then after that construction is done, they'll sell it to another owner who will collect the stable cash flow. So that was an asset that wasn't in the private market before, but now will be available to private investors. So there's growth in the types of assets. With the public to private, that's some opportunity. So yeah.
Kind of the opposite question, which is where I was going. I think James is kind of going there too, is like, well, what's the, if we understand what the fads are, looking at your graph on page 9, when I look at that, I go, okay, so 2013, 2015, 2007, that's kind of the baseline besides that whole economic crash thing that happened. In 16, 17, 18, probably 19, that number looks like it's rising again. And so my question is, are there fads in there? Are there just more interest in conservative holdings? What's going on with that?
I think it's a growth in interest in alternative asset class. And I had done a presentation like this last year. Back in 2000, 87% of all alternative investments went into private equity. In 2018, 54% went into private equity. So
Okay.
some of the money that went to, the share of money that went to private equity is now going to infra. Keep in mind that the total raised in 2000 was here and 2018 was here. So private equity is, raising more too, but the interest in alternatives is increasing.
Is something like electrical distribution networks more stable than solar? I'm trying to throw out, these kinds of infrastructure types. Water seems, water and electricity. I mean, you can maybe do without electricity, but you need water,
Yeah.
right?
So I have a copy of my infrastructure primer that I wrote last year. It's all of 20 pages, so if you need help going to sleep at night, definitely highly recommend it. But in there, I can leave copies as well. When you look at an infrastructure asset, you need to first see where's your revenue coming from. Like, are you guaranteed a certain amount of revenue every year? That's called availability based. Is that infrastructure available? If it's available, they pay you. If it's not, they don't pay you. So there it's pretty clean cut. How much money will you make? You have to manage your operations and make sure that fits your budget.
You, the fund manager.
You, the fund manager,
Not you.
yeah. And then at the other end of the spectrum, they have GDP-based infrastructure where if you have a toll road, the amount of money you make depends on how many cars are on your toll road. And if it's the recession in 2008 and no cars are driving and you don't have any customers, you make no money. And you can't pay your debt and you lose your investment. But other toll roads are availability based. You just make sure people can drive on your toll road and you make your money. So when you look at an infrastructure investment, could be a toll road, but it depends on how your income is set up.
So in general, you can't really say electrical distribution networks are probably less attractive than water. Water, I mean, you see what I'm saying?
Yeah,
Like,
I
can go
understand
without
where-
electricity.
It's kind of a Maslow
I
thing.
need water.
Hierarchy of
Yeah.
Yeah.
air, first comes air, and then
Yeah,
comes
it's
water.
almost like that. I mean,
Then toys, then at the
Yeah, I do, I have some more information I can send you on that. There are certain types of assets that are maybe less risky. Their income streams are more uniform, and other ones where there's more variety. But there's still a lot of variety in income streams, so it's hard to make that generalization.
Okay.
Yeah,
Yeah.
yeah, it's a bunch of gray out there.
Well, who would have thought West Coast ports would take it on the chin when they widened the Panama Canal?
Yeah.
A port sounded like a no miss, but the West Coast ports are being hit really hard.
All these people who own airports, they just see growth numbers, but they don't see that you can now fly from Napa to Dallas, right? And you don't have to go to San Francisco Airport anymore. So it's a dynamic market.
Sonoma.
Sonoma. See, I haven't done it yet.
Not now. Just saying.
Excuse me.
Yeah. Even a
We'll
desalination
second
plant, Catalina Island built one because they had no water, or very little water. For whatever reason, they had heavy rains for seveal years, they shuttered the plant. And so even something like water can be risky when you
Yeah.
infrastructure.
Yeah, there are risks that you can expect,
Yeah.
and then there are the black swan things that you
That you
can't
can't, yeah.
So, I'm curious, with interest rates as low as they are, why would an entity want to bring in this kind of investment rather than just borrow the money and build it themselves?
Depends on if the entity, depends on if the entity, are you talking about like a public entity?
Yeah, like in the United States, interest rates are low, public agencies can borrow at a low rate, why would they not just hire a contractor, build it themselves, rather than say, okay, private investors, you build it for us and we'll
Yeah.
let you take the
Because
profit.
they have poor credit ratings.
I can't believe that, what is the joint, the Port Authority of New York, which owns JFK, can't be broke, they're filthy rich.
But what they are doing, they're doing an RFP process where they said to the private markets, we want you to do this, make us your best bet, and they want to get competitive pricing and certainty of execution, and, you know, they want to pass off the responsibility on cost overruns to somebody else. They want a clean line item on their budget. They want to pass off as much risk as possible.
Okay.
Yeah.
And they are, even for the private sector, they're like 80% leverage. So these managers are getting 80% loans on them. Which brings me to my question, which is like, 4 to 8% returns on an 80% leveraged investment, and at low interest rate time where interest rates go up to more traditional levels, the cap rate's gonna go up, it's gonna hammer the value. I mean, it just seems like there's a lot of things in position there that could give you some headwinds.
Yeah, on that, the open-end real estate funds are 30% leverage or lower, so open-end real estate is less. Open-end infra, these managers are 30, 40, maybe 50%. The
Oh.
open-end funds. The closed-end funds may have more leverage on their investments because they're targeting a higher return strategy. So there's not 80% leverage at these open-end funds, just to
Oh, okay.
adjust that, because I
mis-
understand, that would be a
misunderstood.
concern, yeah.
Misunderstood.
So the open-end real estate is lower leverage, I would say, than the infrastructure funds,
Is-
but it's not that big of a,
'Cause debt's always cheaper than equity.
yeah. So.
I want to be mindful of time here too. We will plan to continue to include infrastructure in the asset liability modeling unless there are any concerns around this table. And this conversation will certainly continue as we go down the implementation route as well. Any other questions before we move on to real estate debt?
All right, I'll put my other hat on, real estate debt here. On page 15, we have a slide called Spotlight on Real Estate Debt. And the top sort of part of the slide lays out potential benefits, and the bottom lays out risks to consider. So potential benefit of real estate debt is potential for downside protection as compared to equity investments in real estate. Potential for income-oriented profile as you collect your coupon from the real estate debt. And that debt can provide a different kind of risk or return for your portfolio depending on if it's lower risk debt or higher risk debt. And if your loans are floating rate that track the movement of interest rates, that can offer you some protection as well, because who knows where interest rates are going at this point in time. Risk to consider with investing in real estate debt. If putting up debt, you don't have the ability to participate in appreciation of value of the real estate. You may not be paid back on your debt. Your payments may be delayed if the borrower has a problem. And then if it's higher risk debt, you have more risk than lower risk debt. You just need to be aware of where you are in the capital stack. And lastly, if you have a fixed rate loan and interest rates move up, you could be disadvantaged because you've lent money at a low rate and interest rates are 5% higher or more. So that's something you need to look at when you're talking to real estate debt managers. What is their strategy? Are they high risk? Are they low risk? What's their view on interest rates? How are they setting their loans? This next slide here is the 4 quadrants of real estate investment. The top half there is debt. The dark blue box is private debt, which is what we would sort of talk to you folks about there. Public debt is commercial mortgage-backed securities, mortgage REITs, and things like that. That's not really a focus of our discussion today. And this next page here, page 17, gives you a very high-level summary of the different ways you talk about real estate debt. And there's 3 more pages following that have more detail on it. The first is whole loan, the second is a B note, and the third is mezzanine loan. If we go on to the next 3 pages, they provide more detail on the differences. So a whole loan is if a borrower or if a lender offers to loan money to somebody who owns real estate, the borrower may put up 25% equity and the lender has 75% of the value in debt that the borrower pledges to pay back over some fixed period of time. And typically it's 10 years. The interest rate can be a floating or fixed rate basis. It depends on who's lending the money. And this is You know, if there's a correction in the market, the borrower can lose up to 25% of the value, that's their equity. So this is maybe a safer type of real estate investment, but your returns are lower. This next one here is a little more complicated, is the B note. So the lender may again lend 75% of the value to a borrower, and the lender may keep the most risky part of the loan and then sell off the safer part of the loan to somebody else for a lower return. So the lender sets up the loan and then they say to Claire, okay, Claire, you take the safe loan, you only pay me 5%, but I'm charging the borrower 7%. So I, the lender, make, you know, a big return because I take whatever Claire's not giving me in return and I put it in my pocket for my investors. So that's a little bit more risk. Because Claire has the safest part of the loan that's always going to get paid off, but I'm going to get more return. And this next one is a mezzanine loan. And a mezzanine loan is typically a short-term loan. If Claire is renovating her building and for the next few years, you know, she needs a bigger loan as she's doing the renovation and she has no tenants in there, she's going to pay me a little bit more interest because there's no tenants in there who's going to guarantee I'll get paid. So typically you get a higher return there because I'm taking more risk on a building that's under construction. So mezzanine loans are shorter term, may have more risk depending on what's happening at the property level. So those are three
Which is
different.
not what we would recommend to this
Good.
So there's.
Second mortgages, that's what they are.
So, I mean, there's different levels of risk. If I'm lending on a building that's occupied, that's, you know, has a good tenant, or if I'm lending on a building that's under construction. It's only 2 years. I only know my money's gonna be at work for 2 years, and it's more risky. So there's a whole range of opportunities there in the debt investment space. If you wanted to look at investment in real estate debt, there are open-end funds, like your open-end real estate funds, and then there are closed-end funds. The open-end funds have fees of 65 basis points to 100 basis points, so a little bit lower than the infrastructure funds. And their yield is maybe 5 to 10%, so that's the total yield. Infrastructure funds are targeting around 10% maybe. So it depends on the level of risk that you want for the portfolio for the return. On the closed-end fund side, there are a lot of different ways to invest as well. Some of those managers are doing, there's more risky mezzanine loans that are shorter term where you get a higher return, or you're taking more risk. And those just, I know we're short on time here, but that's a little bit more color on what that is. I would say most of our clients that we work with are more focused on the real estate equity investment world. Some clients look at real estate debt, but the majority are focused on the equity options on that.
You don't have to loan 75%. I mean, in my experience, you know, we lent a maximum of 60%. Most of the time, 50%, and a maximum of 60%.
That's a fair statement. You don't always have to loan 75%.
And doing A and B loans is a really cool way to go too, but take the A side.
The safer side.
Yeah, or take the B side, either way, but if you make a good loan, let's say you make a 60% loan and 6% interest, it's just a great loan. And then you go to somebody else and you say, well, look, I'll sell you half of that, the bottom half of that loan at a 4% rate of return. And now you've only got a 30% loan to value ratio. And by the way, you've got us behind us, because they got to pay us first, or they got to pay you first and then us. So we're making a 3% spread or 2% spread on their money.
Yeah.
So taking the B side is really great on a loan that you just as soon have the whole loan anyway. If somebody will buy some of it ahead of you at a lower interest rate, that's a really sweet way to go.
Yeah. I mean, one thing with where we are in the market cycle right now, I ask real estate managers all the time, are we overvalued, are we near a correction? And so if you make a loan right now on a real estate investment and there's a correction, the potential for impairment is out there, right? And so it depends how much of a loan you make, if it's 50, if it's 75%. The managers who are running these funds, we also like to see a diversity in number of investments and in type of investment, geographically sponsor who's managing the investment, just so that no one investment determines the outcome of that portfolio.
So, Claire, I warned you about this about 20 minutes ago, so, it was an hour ago. And you hit on it earlier, when Robert and I were talking about the real estate debt part of this yesterday, and, you know, do we want to be on the higher end looking at you know, being in this mezzanine B notes and that kind of stuff? And keep in mind, we will be hiring a manager to manage all this for us. But where we want them positioned, and it's not in this part of the slide deck, but you've got the same kind of structure where you can go with very, very safe, low return, all the way up to kind of an opportunistic, high return, high risk type structure in the real estate debt world. I think the question is, and one of the questions Robert and I threw around yesterday, and I don't think any of us here, I know I don't, have a good sense of what's the objective for the portfolio in including real estate debt. And I would ask the same thing for infrastructure and then potentially private equity. Are we, and Claire mentioned this early, are we trying to increase returns, or are we trying to decrease volatility, or are we trying to do both? And both may not be achievable. And so if we think about that on a piecemeal basis, we may get a different answer than if we look at it globally across multiple asset classes. So it's kind of a bigger picture question that came up as Robert and I were discussing this yesterday. So I kind of wanted to throw that back out on the board. What is the objective? Because, you know, Lee, I think you've mentioned we could take money out of fixed income and put it into real estate debt. But from other trustees, I've heard concern about the volatility in our portfolio, with the heavy emphasis on equity. And that's not really, I don't get a sense that I don't feel like that's the discussion that we've had of where are we trying to go with this asset allocation. I do think it's good to have this discussion about these asset categories. And maybe with adding new asset categories, we can do a little bit of both. Increase our total return and decrease equity with a diversification effect. But I mean, just want to throw that out there and see what anybody's thinking.
So where do these track with the equities market?
The real estate debt investments?
Yes.
I mean, they're not perfectly correlated with it, but everything is somewhat correlated to what's happening in the economy, right? So if things go sideways in the economy, businesses don't do as well, they might have problems servicing loans.
So you're not categorized more toward the actions of bonds or more toward the actions of equity markets?
It varies. So when you're looking,
It depends.
Okay.
right.
Yeah.
So when I think about the big picture of the portfolio, and infrastructure and private equity, you know, when we're thinking about the target allocation and building a new asset class into your target, that's an asset class that you intend to invest in, you know, forever, right? Real estate debt is, we're talking about on an implementation standpoint. So when we think about real estate debt, Jan mentioned you can have riskier allocations or you can have less riskier, more bond-like allocations. And that somewhat determines whether you think about it as part of your fixed income portfolio or your real estate portfolio. So real estate's going to have a growth component, right? You're looking to real estate to get an illiquidity premium out of that, a differentiated opportunity set, that's for growth. Fixed income is supposed to be inflation protect or downside protection, excuse me, and parts of the real estate debt investment, kind of the safer side of that. You'd look to that for downside protection, higher yields potentially than the public fixed income market. I think it's a good point defining what you want out of this.
If I could add another thing, insurance companies are big lenders to real estate buildings,
Right.
and they'll lend to the nicest building in the biggest market, and they'll do it, you know, in a very safe manner, maybe 50%, maybe less leverage, and they'll get a lower return. But then you have the manager who will lend on that crazy, you know, mixed-use shopping development down the street and will want twice as much return. So it really depends on what kind of lending is being done, what kind of return you want out of it.
I think we need to be real clear that, to me, that infrastructure is like a REIT investment, and it's like a REIT. It's kind of a, part of it's real estate, part of it's personal property, but it's kind of a REIT run by a venture, private equity managers.
But not publicly traded.
But not,
It's
yeah, but
similar
not
to
publicly
real
publicly
estate,
traded.
yeah.
Where mortgage lending is really within your fixed income asset allocation. Just because it's loaning on real estate, it's still a bond. It's a backed, it's an asset, it's a loan that's backed by real property. And as such, what I see the benefit of doing real estate lending is we have a target of 2% on our fixed income segment of our portfolio. And we need to do better than that, and we can do better than that. Making 4% on mortgages, if we just compete head-to-head with them, that's not competing with our equity portfolio. With our equity portfolio, we think we're gonna make 6 or 7%, great. But on our hedging side, on the fixed income, well, like I say, we're targeting 2%, so if we can improve that, we're improving within that segment of our portfolio, not our overall picture. Well, it impacts our overall, but you gotta put the emphasis in the right pocket.
So you're saying that real estate debt is all about increasing return?
In the fixed income segment of our portfolio without increasing risk. You gotta remember, you know, everybody's got in the back of their mind, oh, mortgage debt, the great crisis of 2008.
Right.
There wasn't any CMBS in that at all. It was all residential loans. It was all a big scam put on by the Wall Street guys and the bankers. That has nothing to do with CMBS, commercial mortgage lending. You didn't see any of that. The only last time you saw any commercial lending issues in this country that had any broad impact was during the savings and loan crisis during the 1980s. And that was a government regulated, brought on problem where they just didn't regulate savings and loans. I mean, that was another scam. So that problem has been long resolved and not going to come back. So don't get the idea of residential lending and commercial lending anywhere. They're different animals completely.
And James, I think you mentioned this before, but the practical way for this portfolio to invest in real estate debt would be to go through a fund, and funds can be expensive, or they are expensive. So what, if there is a decision to move further down the road of implementing a real estate debt allocation within, sounds like your fixed income.
I don't know that you need to use a fund. I mean, you're a really small pension plan, and I think you can work directly with a lending firm, a regional brokerage firm that manages portfolios like yours. And you give them an allocation, and then they fund loans over time and build you a portfolio. Because you don't just go out and say, well, I want to put $100 million into mortgages today. Well, they don't fall off the trees. Somebody already owns those mortgages, and they don't want to sell them. So you have to wait until new loans are originated. So if you want to build a mortgage portfolio, you have to have some patience.
Yeah, one of the things that we do, we look at managers, is what is your track record? What has that manager's strategy been? Who has been there? How have they performed? How many loans have they done? How many have paid off? We go into a lot of detail with these guys because we want to make sure whoever is originating those mortgages can service them through that. So working with a group that has a proven track record is something we really look
Absolutely.
into.
The
Yeah.
most, you hit the nail on the head, that's the most important thing is the track record, and that's it. Look at their portfolio.
So Lee, in your scenario, the decision-making with a management firm, a manager, is at that level. With what you're saying about the final decision is made in this room or by our staff?
Oh, I think in this room, you wanna, with the blessing of our consultant, I mean, that's what we're paying Callan to do, is to vet potential brokers, and then to bring those bring their choices to us.
So it's difference between a fund manager versus
Yeah,
a
yeah.
broker.
Well,
And
a
you gotta
broker's
make that clear to
really,
everybody.
a fund manager is a broker. You have to have a real estate license to originate loans. So it's a different term, but, and I think, sizing is really important. You go to some giant firm, and they're not gonna pick up the phone for our call. Or you go to somebody that's too small, some, Joe's mortgage company down the street, he doesn't have the track record, he doesn't have the ability to generate the product that you need, or he's already backed up with his clients, and he can't really service you.
Yeah.
A lot of people say, oh yeah, I can get you the loans, but you have to look at a company that can generate the new business for you. I mean, most companies, very successful companies in the mortgage business now, they're not looking for new clients.
Yeah.
They're looking for loans to satisfy the clients that they already
So,
have.
so we'd be asking them to find a slate of regional brokers to analyze and bring back to us.
Qualified
for
as
choices. Is
what
that
would
you're
you
saying?
consider a portfolio manager.
One thing we look at when we work with fund managers is what is their alignment of interests. All of the managers that we work with generally contribute some of their own capital to the fund, which means that they're aligned with you. If you do well, they do well. And so we would look to see the alignment of interests. Is that, is whatever group that's managing your money, are they also investing alongside you and standing next to you for the long haul? Because that's where people got into trouble in the CMBS heyday, or when people assembled portfolios and they just sold them off, and then they got a fee, but they didn't care how it performed because they were only incented by their fee. So alignment of interest is very important.
Having a fiduciary between you
Yeah.
and the decisions is important, because you'll have a lot of personal liability if you don't have a fiduciary in front of you. So it's careful.
So I feel like there's a little bit of, we're talking about a fund manager, but we're talking about brokers. I mean, and I'm not sure we're all on the same page here, so I want to try to clear this up. My thinking, and I think this is Claire and I are on the same page here, is we were anticipating that we would hire an investment manager that we would allocate some money to in this space potentially, and they would go out and buy existing bonds, maybe work with brokers that are originating mortgages, but we would be one investor in a fund of pooled assets, and we would get a broad diversification through that. What it sounds like you're talking about, Lee, is coordinating with brokers that originate mortgages with our money one-on-one, and we're not pooled with anyone else. We're actually owning mortgages there. And am I characterizing what you're thinking accurately?
You could do it either way, but if you deal with a broker, you're gonna deal with one. Because if you dealt with two or three, they'd never call you.
Okay. So, I mean, working with a broker, I would be concerned about the diversification aspect. Because
Well, you're so small, I mean, if you, let's say you
Exactly.
allocate.
That's exactly my
Well,
point.
But if you allocate $10 million, just say you make 10 $1 million loans, you got diversifications, you're not gonna buy it all one day.
Right.
And just because
But if
you
we're gonna
own
allocate-
pieces of 10 mortgages versus 10 whole mortgages, what's the
If we're gonna
difference?
allocate $10 million to a fund, then we've got pieces of 1,000 mortgages.
Right.
So we've got a broader diversification there, and we've got a manager that does this full-time, doing it for us, rather than people here, you know, the broker calls us and says, I've got a deal for you.
Well, no, I mean,
I mean,
when
who
I
makes
say,
that
when I say,
decision?
when I say a broker, I mean, you'd select a broker who, in effect, is an asset manager. Somebody who meets the standards of an asset manager.
Okay.
Not just, you know, Joe real estate broker down the street who happens to make loans on the side. That isn't what I'm talking about. Somebody who handles pension plans
Okay.
and endowments, and that's
So
their business is.
They have
managing
all
large
the
portfolios.
decision-making authority on individual mortgage investments. This board and this staff would delegate all of that authority to them, correct?
You know, typically, you have the manager, and Callan, you provide us with a set of criteria. We only want to make first deeds of trust. We don't want it to be more than 60% loan to value. It has to be on income producing property, not land, not bowling alleys, not trailer parks. Certain types of property, certain types of agricultural product. Basically one page set of criteria. The asset manager then comes up with a loan, and he contacts the board or you and says, here's a loan that meets the criteria, we want to do this, is this okay with you? And you go, yep, that meets the criteria, fine, go ahead. So you get a direct review. You have the right to say no. And when you have the relationship, the phone only rings with loans that you want to fund, because the manager knows what the criteria is, and that, you know, there's a symbiotic relationship, but at the same time, it gives you the benefit of knowing what you're invested in.
And then, I guess, we've seen some investors invest in real estate debt through funds, and some do, I think what you're talking about, a separate account where a investment manager manages it. Separate accounts, though, from what I've seen, managers generally want like 100 million ticket, or 200 million, or pretty sizable commitments to do that work for one investor. Otherwise, it's just more efficient cost-wise, and a better value for the investor to invest through a fund, because you get 100 different investments rather than just 10. So I've seen sort of separate account that you're proposing, but it tends to be for portfolios of like 100 million, 200 million of real estate debt. And the reason they make them that size is so that they get appropriate diversification within that real estate debt. I think that's what what I've seen in the market so far. And then in terms of managing those loans after they're made, who is following up with the borrower or handling
Yeah,
the
asset,
day-to-day?
the manager.
Yeah, and
does
making
all
sure
that.
people pay and the covenants are broken, and it's
Yeah.
a lot of work, it seems, on the back end, I'd say.
It's not that.
As long as things are performing, but there's still things that need to be done.
And I've been concerned about our very risky portfolio. So I don't think we want to add the risk of asking the people around this table to make those decisions. I would rather be sure that Callan was behind it.
Yeah.
Well, you front load it. Callan and the investment manager work out the criteria. Here's the loan criteria. And then that way the manager knows, okay, this is what they want to do. They don't want to make 80% loans on swampland. They want 50% loans on 100% occupied office buildings. And then that way, so the broker knows, the manager knows what the client wants, and then they only bring what the client has said that they want. And then generally, plans have like an investment committee, which can be anywhere from 2 to 5 people, that the loan comes in, the investment committee goes, yep, that meets the criteria, fine. Or, you know what, we just don't like the fact that, it's in some area that we don't like. And they can turn it down. But it's generally, they don't turn it down because the broker, the asset manager already knows what the criteria is.
I think for the funds, the things that we like is the alignment of interest. The fund manager is putting in capital too. And that's important. And if it's a broker, I'm not sure if they're investing alongside you. I don't know what the structure is. For our clients who do separate accounts, it's just been large ticket sizes because they want the attention of the manager. Otherwise, the manager will operate these diversified funds, which more investors have access to. So alignment of interest, diversification of portfolio.
I typically don't like pools because the clients don't really have any eyeballs on the money. And the manager's making loans, and the manager gets a fee for originating those loans. And in the past, it's often happened, the worse the loan, the higher the fee that the manager charged. And the end user, the investor, doesn't really know that. And so pools create a conflict of interest. I'd rather have whole loans.
You're not picking individuals.
I'd rather have whole loans, or at least be in a loan with 2 or 3 other pension plans or 1 other pension plan, whatever the need for the funding is at that time.
Yeah.
I'd like to say at this time, we haven't even decided that we're going to do this, and now we're talking about how we're going to do it.
Right.
I think we're a long ways away from something like Lee is
Yeah.
suggesting. For a diversified board who has a lot of things they're doing and are busy and can't set aside the time to come in here and decide we're going to buy a loan.
I wouldn't
think we're way
suggest you guys be loan committee. You're not in the loan committee, you're not in the stock picking business, you're not in the loan committee business. I'm not suggesting you're in it. But if you are gonna think about a product, you need to think about, or at least you need to understand, okay, well, how would that work? How would we get from A to B, and you get a ribbon around it, and then you can think about it as a class. But if you don't understand the class to start with, like we talked about infrastructure in detail, then it becomes just an amorphous sort of thing and gets.
So I have a question. So if we were to look at the real estate investment pool as you were presenting it, are there returns on investment that are 3% or more after fees that would be conservative enough that we would want to look at that as a partial displacement for some of our 2% fixed returns?
I mean, that one, I want to look at that and see about what the opportunity set is there. Most of the things that I've seen are going to be higher risk, higher return. So in terms of things that are sort of, as you say, trying to get a 3% return after fees, I haven't seen a lot of those products myself. But that being said, I focus a lot more time on infrastructure, so it's some research we can get back to you.
So I guess that's a question. So if the board was interested in that kind of a product for that purpose, because that's what intrigues me. It's like, okay, if we could take a third of our 2% return investments.
Yeah, in that space, in that space.
And move it to 3.
That's a great question. Yep, let me do some research.
Yeah, I think that's where the conversation will go in terms of the implementation part of it, right? This conversation is obviously not over. I think it's a good one to keep going. But to your point earlier, it is once we get down the line of how much do you want in fixed income and then what do you want that to look like. So Dan, I think those are great questions that we should address on the implementation side. We are just over 10 a.m. here, and so we want to be sure that we get to the private equity discussion. Is everyone okay moving on to Gary's presentation on private equity? And again, our plan in the asset liability modeling is to model both with and without private equity. So we'll see both and can continue there, but we certainly want to highlight, again, kind of what would it look like if you did choose to invest in private equity? What are the benefits, considerations? And what would the role of it be within your portfolio? Why is it different than other investments that you have now?
Great.
Morning, everyone.
Morning.
Hanging in there? It's a lot of technical stuff. I'll try to keep mine a little higher level and hopefully be somewhat perky. It's not my nature, but. Oh, okay, great, thank you. So I have a book where my page 3 is your page 31, which is actually 30, which is the table of contents. So what we'll cover today is, talk about what is private equity, let's define it. Talk about the benefits and challenges, pros and cons. Who's doing private equity? What are the different strategy types that make up the market, and somewhat why? What benefit are they providing to the people that are using them? We'll spend, look at the size of the market. We'll look at the size of the infrastructure market. We'll look at the size and shape of the private equity market. I'm going to spend some time on cash flows because these are private closed-end vehicles, something which I don't think is currently in the portfolio. So we'll talk about how cash flows through these investments. And then you fund them, and then the money comes back. Then we'll talk about returns, because that's what private equity is all about. So we'll save the best for last. And then talk just briefly about, if you move forward, what would an implementation process look like? And then there's a quick summary. So on page 31, there's what is private equity? You're investing very simply in private companies. And to get to the private companies in a professionally managed manner, you had to invest in limited partnerships. And those partnerships buy a bunch of companies. Go out and buy that. For your implementation, there would be kind of a manager of managers for all these partnerships, because you can think of each partnership as kind of an individual stock, and we'll look at a graph of that a little bit later. Private equity is just another thing you can do. It's another arrow in your quiver to finance future liabilities. And it's a different opportunity set. These are, there's hundreds of thousands, even millions of private companies in the US that you're not accessing currently. And they're very good businesses. This is commonly viewed as a separate asset class, mostly because of the mechanics of it, which we'll get into. It's not like public equity where it's exchange traded, so you have to treat it a little bit differently. But it's really just a different style of equity. You have growth, value. This is just private. So you'd be thinking this is a relatively small carve out of your public equity portfolio that you're putting in private companies now instead of public companies. So it's a different style of equity. Key benefit, no one would do this if they weren't seeking enhanced rates of return. So that's the whole nut. But there are some other diversification benefits that flow from this, and we'll hit on those, but what you're really looking for is return. As Jan highlighted, there is no free lunch, so this comes with its drawbacks too. It's illiquid. So this is not something that you can cut a benefit check from. But as long as the allocation is small enough so you're not going to need that cash, then that's not really a risk per se, along with your real estate and everything else that's illiquid. You have to keep it balanced. And then there's some complexity. As I mentioned, this is a different kind of investment process, and we'll go through some of the complex elements as we walk through this today. And at your board level, with the implementation that we're suggesting through a fund-to-fund, there isn't a lot of complexity because the manager's actually doing the mechanics of all this stuff. If you were at CalPERS, they're going directly into partnerships and directly into companies. So they have a big staff that's actually managing the money. That's not going to be a concern for you. So on page 4, the value proposition is also very simple. This is companies. So there's revenues, there's expenses, and if your revenues are more than your expenses, you get earnings, which is what makes a company valuable. And if you can grow the revenues and the earnings more than the expenses, then that's a good investment, public equity or private equity. The difference between public equity is your large cap value managers looking at their opportunity set saying, well, the management team says they're going to do this, and so we're going to buy a small portion of their stock and then hope that they get the job done. Because we believe they can, but you never know. With the private equity market, your underlying managers are going to actually be owning the company in a majority context, or a couple of them together are going to be owning the company, so they can dictate what's happening. So it's a very high impact, and when they buy the company, they say, we know what we're going to do with it, and if management's not getting the job done, then we're going to change management and make sure that it gets done. So there's an active value creation plan associated with these underlying private companies. There's also an alignment of interest, which Jan said is important. Managers do get a carried interest, but the managers of these companies also have to buy and get options in the companies. So if they work like the Dickens for 5 or 7 years, they get a chance to achieve financial independence, which most company managers wouldn't otherwise. So it's a very high intensity kind of a business with good incentives in place. Companies are managed for longer term gains, whereas public companies are kind of managing to quarterly earnings. They don't want to disappoint. You can do more reinvestment early in companies, retool plants to make them more efficient, beat the competitors, grow their market share, and be out of the public eye as having to have steady cash flow ongoing. So when all these are combined, it's a kind of a different style of equity, as I mentioned. Those are kind of the key elements of how this is different, why it's similar to public stocks, and why it's different. Any questions or comments? And as kind of a simple example, let's say there's a distribution company that's been very successful kind of east of the Mississippi. Family hasn't wanted to grow it because that's risky, but maybe the owners don't want, the kids don't want to take it over, so it's time to sell it. A private equity company will come in and say, okay, we're going to roll this out west of Mississippi. How many trucks they need to lease, how many warehouses they're going to do, how many salespeople they have to hire, what their penetration time is. And so if they can get that job done over the holding period, which is kind of 3 to 5 years for these companies, then they're going to have a company that's twice as big, twice as much revenue, twice as much earnings, and you're going to get probably more than twice your money because they'll get a better multiple for it. So that's kind of an example of what these guys are shooting for. Talking about the challenges a little bit, we discussed the illiquidity. That's something you try to manage at the asset allocation level. Implementation is the primary risk. Going out, finding these companies, winning the opportunity to invest in them, getting the right management in place, managing these plans and ultimately, or managing the implementation, ultimately selling it, is a very complex skill set. You need people that are pretty talented, pretty smart, and teams of these people. And many come because the fees are good in this industry, but fewer succeed. So the implementation risk is you have to get into the better partnerships. That's part of the fund-to-fund manager's job, or a key element of the fund-to-fund manager's job is to get you into those best partnerships. Otherwise, you won't get the kind of returns you're looking for. On the complexity side, it takes about 5 years if you start today, 5 to 7 years, and you've got, say, a 7 or 8% private equity target to actually hit that, because you commit money, then the GPs have to go out and find money to, companies to buy, and so it's a long ramp period, and we'll look at a graph of how that works a little bit later. From your board perspective, you're going to have to analyze the performance. The mechanics are different. It's not like Claire taking you through your public equity report. It's a different rate of return. You use time-weighted returns in public space. There's an internal rate of return. There are return ratios. It's pretty easy to understand with a little bit of tutorial, but it's a whole different thing. So you have to take your private equity portfolio kind of out of your regular portfolio, look at it in depth, and it's just a little bit of a different language. And we'll touch on some of those things as we go through this. J-curve. Because these are projects, there's kind of a startup period, a value development period, and a harvest period. At the beginning, the returns can be slightly negative for a couple of years. So you don't have a lot of money at work then, but everyone that builds a private equity portfolio is going to probably have early returns that are slightly negative. So be prepared for that. You're being visionaries here for future generations. And then fees are high related relative to public equity. Your fund-to-fund manager will probably charge you somewhere between 65 and 85 basis points, and then all in. And then the underlying partnerships run at about an average of 230 basis points. So you're going to be paying 3% more or less of underlying fees on this. And that's including the management fees and the carried interest. But the returns that we look at later will be net of all this. So there's still a premium left for pension fund investors such as yourself. Page 6 is simply who's doing this, what's your peer set. Public pension funds are the largest segment in this market, and you can see other types of pension funds, foundations, endowments, truly institutional investors are doing this. So you're in very good company. We flip to the next page, number 35. There's a list of strategies. What are these private equity opportunities? What's the fund-to-fund manager going to be investing? Well, there's venture capital funds here in the Bay Area, Greater Bay Area. That needs no introduction in the world of Google and Twitter. The goal is to get into those types of companies early on. For buyouts, those are larger, more mature companies, cash-flowing companies, like the S&P 500. Technology is becoming more of an element like it is in the S&P 500. And those are typically segmented by size. You can buy really small companies that might have only $10 million of earnings, of cash flow, up to very large companies that are delisting public companies. So this buyout market is segmented by size. There's small, there's mid-market, there's large, and then there's these mega funds, KKR and Blackstone, who you might hear about in the Wall Street Journal. Special situation funds are buyout funds that are a little more specific. So say a fund that was going to do buyouts of companies only in the energy industry, or only they were financial services sector specialists, so insurance companies, banks, other kinds of lenders. So because that's a single industry, it's a little more volatile, it gets a different category. You can also go out and buy used partnerships, slightly used partnerships at a discount, and that's a pretty good business. So that would be another thing that might go in this other bucket of special situations. And then there are two debt-related strategies. There's a private high yield, and that's an equity-related strategy because you're going to get kind of a low double-digit coupon like the high yield market, but you're also going to get a piece of the equity in the companies in these private bonds. And so that'll get you another, kind of high single-digit addition to that. And then there's restructuring funds. All companies, the prior ones were equity-oriented. The companies are going to grow and do well. There's also a sleeve of the market that help trouble companies, companies that borrowed too much or had bad management, get turned around again. Good businesses, bad balance sheets, or bad situations that can be rectified. And the next page kind of overlays these strategies. Venture is mostly for small companies on the left-hand side of the graph. As you get bigger, there's a lot more kind of financing opportunities that these other companies, other strategies. There's the growth curve for the buyouts and growth equity, and then restructuring is on the right when the companies kind of need to get a restart. And so, anything that anyone would go to Wall Street to kind of get fixed, there's a private equity solution for them. So it's a part of the financial economy in a very broad sense. Turning to page 37, we're going to shift gears and talk about the size and shape of the market. Is there any comments or anything so far at this point? Okay. So busy chart here, so I'll just highlight a few things. The top box is the number of funds that were formed in the US, private equity funds by strategy. So you can see back in 2008, there were only about 360 funds formed. That's, kind of year over year. There's a pretty big opportunity set. If you're only going to invest in 10, you want someone to kind of boil the ocean, go through pretty much all the 300, and then pick the best ones for you. More recently, over this 11-year period, there's been a lot of growth in the market. And the number of funds being formed every year has increased by about 3 times. So about 1,000 a year, 700 on average over this time frame. So the market's growing. We expect that it's going to keep growing because, as Jan highlighted, there's a lot of interest in all the different private strategies, including your own. The bottom table is the amount of money that went into those funds, kind of by strategy in total. So in 2008, you can see that there was about $265 billion that went in. Then we had the recession, it went all the way down to 86. And since then, it's rebounded. So over this period, there's about a 4.5 times growth rate in the actual capital getting committed to funds. So it's a growing market. So we talked about the strategies. I guess let's not move off that page just yet. There's one more thing I wanted to highlight. On the right-hand column, on the top, you can see venture capital is 42% of the investment opportunities over this time. If you go down to the capital table at the bottom, the top line, venture capital was only 12% of the money though. So most of the money is going, the 60% right below that is going into buyout funds, which were only about 1/3 of the opportunity set. And then the debt-related and other things are much smaller, they're single digits. So how do you put together a portfolio of these strategies that makes sense?
Gary?
Yes.
Question there. So the number of firms has tripled, but the assets have only increased by roughly 50%.
The asset growth is actually, if you...
265 to 390.
Oh, yeah, you're right. That was not the right math.
So what's happening there? Is the private equity market dominated by a very small number of very large firms, and then you have the also-rans?
Mm-hmm.
Or is everyone getting smaller?
The market is growing over time. The big guys have been getting bigger, but there's just a handful of them. So most of the growth in the market is at the bottom and in the middle.
Okay.
Yeah.
No comment. The same amount of deals.
So on the next page is a typical global fund-to-fund structure. Kind of all strategy, one-stop solution, which we would recommend for you. There would be an overweight to venture capital. There's a lot of good profitability there. If you can get into the right funds, and these folks can. You want to probably underweight the buyouts, which were over half the market. So scale that back a little bit, and then have somewhat market weightings in the debt-related, because those are more kind of a suspension system in the car where the equity is the engine. So this is typical. If you think of venture capital as small cap, that's a smaller piece of the portfolio, 20 to 25%, mostly in large cap, and then a little bit of fixed income like things for more stability, especially in times of recession when equity isn't doing as well and there's more restructuring opportunities.
So we've talked a lot about how a fund of funds access would be appropriate for your portfolio. And to me, this takeaway is, well, if we were gonna build this on our own, this is the pie essentially that we want to build to. But you don't have the assets to go make those individual commitments to direct funds. So you have to pay for diversification. There's certainly a consideration in the additional layer of fees with a fund of fund, but you do have to pay somebody to build you that diversified portfolio. We wouldn't recommend saying, oh, we don't have quite as much money, so let's just go direct with venture. We do want to access the diversified opportunity set.
So before private equity, who did all this stuff? These guys basically shadow bankers that are doing all the things that large commercial banks do?
Before private equity and venture capital came about in the 70s and early 80s, it was all just private owners. There wasn't really anyone doing this. There were folks that were kind of bootstrapping companies. They would, they were putting a lot of leverage on a private company, but they weren't really building portfolios of these things.
So Milken kind of started this with junk bonds?
It started about the same time as Milken. I wouldn't.
But companies always needed these kinds of services.
Yeah, but until the 70s, there really wasn't much of a market. I mean, maybe insurance companies were doing it through more aggressive lending. Those were the shadow bankers, but there really wasn't an equity solution unless it was a person or.
The number of public companies has gone down over time as
Yeah,
well, right?
it
More
is
companies
shrinking.
are held within private entities. I forget where I saw
Now, is
that.
most of this business conducted with public companies? Who are the bar? Who are the customers here? Well, venture capital obviously is guys in their garage who are, getting, all this front loading. But, restructuring and these other segments of the wheel, are those public companies, private companies?
Mostly private companies. After World War II, there were a lot of businesses started here in the US with the big expansion that went on and, the industrialization and all that. And there's a lot of generational change. That's, a key source of companies. Also, there was the period in the 60s of conglomeration where people were buying a bunch of unrelated businesses as public companies. And then, so now there's a lot of, taking divisions out of public companies that are orphaned and not strategic for them as they change CEOs and, want to go in a different direction to be more profitable.
So would public companies represent a very small piece of this market, this customer base?
Yeah, there is the element of, well, you can have a public company that, the stock price isn't really what it should be, and so they're gonna try to take it private, fix the company up again, and maybe take it public again. But that's a pretty small portion of the opportunity set. But, that's ongoing. You hear about them all the time, once or twice a month.
James, did
Lee, I read an article recently, I think it was in the Atlantic, about Remington Arms. Went through a private equity thing, and it didn't go well, but that was an example of what you're talking about. It was a restructuring deal, so.
Yeah, and in the recessions, there are a lot of companies that go bankrupt, and you can go in through, some of these folks will go in through the debt, try to figure out, when you recap it, how much debt can you put on it, and the rest of that old capital structure that's much bigger is going to become equity. So they try to buy the bonds that are going to convert to equity, and then they'll own the company just like it was a buyout, for instance.
Other companies like
Vulture.
Dollar
Vulture.
General, right, or the Dollar Store or Petco, they might have had private equity ownership at one point, and then after the private equity company expanded the business, they listed it on the public markets or sometimes.
Yeah, and you can have, kind of in the paper, you can see that Oaktree, who is a big distressed debt manager, is fighting with KKR, who's the equity manager, and they had a company go bad on them over, getting control for the new business going forward. It's still a good business, but it needs to be recapped and.
Because I've seen enough in the distressed debt segment of this market, which is a piece of it. I wouldn't want to invest in them just because they're pretty hardball players, let's just say.
Yeah.
Pretty unethical stuff.
Okay. And, that's a small portion of the market.
And just that piece of it.
And it doesn't always have to be that way. There are distressed managers that work with unions and have good reputations. KPS, for instance, is a manager that, is doing well because they work with unions to kind of help them save save the businesses that are in trouble where they have union workers.
There are angels, and they're
Yeah.
they're either angels or devils. And that's
Yes. Right. So if we kind of move on from what the portfolio looks like into the cash flow segment of this, on page 39, You're here at the top, and actually what I'll do is I'll start at the bottom. What you really want to do is get into these good companies. And so, Google was a venture capital company, Facebook was a venture capital company, Burger King was a buyout company. This is very household name kind of stuff. Hertz Rent-A-Car was owned by a buyout shop for a long time. So you want to get into those. And to get into those, you have to invest in these partnerships. And so, Kleiner Perkins and Sequoia are probably the two most famous venture capital funds. There's a lot of other good ones. On the buyout side, Blackstone and KKR are well known, but most of these are not household names that you'd recognize in their funds. Instead of being 10 to 20 billion, which you read about in the Wall Street Journal, they're raising anywhere from 500 million to 7 billion. So that's kind of more where you would be putting most of your money. And you have to invest in a lot of these partnerships to get appropriate diversification. And they all have beginnings, middles, and ends, so you have to continually refresh new partnerships into the portfolio because ultimately they're all going to expire. So what you're going to do is consider outsourcing that management of this portfolio to a fund-to-fund manager. Go find us the best partnerships, take care of all the paperwork and negotiation and closing and monitoring, and give us a report of how things are going on. So it will have a look and feel very similar to how you treat your other managers, particularly your real estate managers. So why don't we flip the page? So ultimately, the capital flows from you down through this chain of vehicles to the companies, and then profits flow back up to you. If we turn to the next page, we look at the cash flows through time. So we're on page 40 now. The top slice is when you make a commitment maybe to your first fund of funds. When you make a commitment, these vehicles typically go and then commit to the underlying partnerships over a 3-year period. This is not a cash flow event. This is just a promise to pay. So let's say this fund of fund is kind of 300 million in total. So they invest in 10 partnerships per year. So at the end, they've got about 30 partnerships, good diversification. And they've invested 100 million a year, so it's 300 million is committed. The next line down is the capital flowing into, from you getting cut to the general, through the fund of fund to the general partners, and into companies. So the first commitments to partnerships begin to buy companies in year 1, but then at the end of year 3, the last general partner has another 5 years to go out and find companies. Because it's a long, they have a 5-year commitment cycle and a 5-year harvesting cycle, and there's some extensions to wrap things up. So, the decision you're making today, we're going to give a fund-to-fund manager X dollars. That's not really going to get invested fully for 7 or 8 years, because they have to go out and find these companies and diversify over time. The next line down is the good news. This is the money coming back to you. In about year 3, the first general partners are going to have some early wins. They'll be selling companies, and the capital flows back to you, and there's a bit of a bell curve effect. And from this first 3-year slice, or your first 1-year commitment in year 1, there'll still be some assets at work in year 17 or 18, but not a lot. So you obviously, after you commit in year 1, you want to put more money in and continue this program ongoing. Is that clear enough? Is that clear? Then page 13 is something that's a little more granular on how this works for an individual partnership. Let's say you give $1 million to a KKR fund. It's going to take about 5 years for them to invest in all the companies. Then they'll have a little bit of reserve where they can add on to the companies. So you'll be getting capital calls from that partnership for about 8 years. That's the blue lines going down. Whenever there's a blue line going down, they're buying companies. That's the gold line going up. So as you add these, year by year blue bars, cumulatively the gold bars add up to the year NAV. You can see in years to the asset value when you're holding. Then in year 6 and 7, you begin to see that the green bars, which were the distributions I mentioned, become more than what you're paying in. And so the asset value begins to get paid down and liquidated. So the project is fully completed. Okay, So now we're going to talk about returns. We're getting very close to the end. Page 14. 42, sorry. What I'll do is direct your attention to the green bars at the bottom. The all private equity is a diversified private equity portfolio. And these are horizon returns, so you're standing at year end of 18 looking backwards. So if you had invested in this database of partnerships, this Cambridge database of partnerships, and you look back 20 years, all private equity would have returned 12.7% versus the S&P of 5. So there's a pretty good spread there. And there's a positive return in 15 years. 10 years, this is right after the recession, and then public stocks took off. Private equity had a little bit of a hard time keeping up with that because stocks were going up like hadn't been seen for a long time. So there's very little premium there, but over a 5-year period, you begin to see about a 3% plus premium asserting itself. And one thing that's nice is if you just look at the last year in 2018, that was a tough year for public stocks. Just like your real estate portfolio, there's some appraisal smoothing, accounting that goes on. And so you get some benefit of that diversifying your equity portfolio. So you're getting an equity return, but you're getting a little bit more diversification. We'll look at a little bit more at that in the future. Ultimately, these two will converge, but you're getting a smooth effect. I talked about getting into the best partnerships, so if we look on page 43, if we look at the all private equity line, the median for the database since inception is only about 10%. Okay return, but the S&P right below that had an 11% return, so you have to do better than median. The upper quartile is 18.6. If you have a diversified pool of these things, probably where you're going to end up is somewhere in the middle of the second quartile, somewhere between the two. So we say, kind of look for a mid to low teens net return from these investments, even after the fund-to-fund fee. And then on page 16, we're looking at this in time-weighted return calculation. So this is, if I'm looking at what this effect is bringing to my overall portfolio return, it would look something like this. The green bars are private equity. The red bars are the S&P 500. And then the blue is the differential.
Your colors are different for some reason,
Oh.
so just so people.
Okay, yeah, thank you. It's interesting that changed. So the blue line is private equity. The dark green or bright green is the S&P 500, and the olive green is the differential. And you can see that there is a pretty good return premium if you look at the olive green line through time. And then the next page, 45, we look at the relative standard deviation of the two. So this is also something that you would benefit from. The blue, again, is private equity. There's that accounting-based kind of quarterly appraised value, so it's a lot smoother than the public equity markets. Then you have the standard deviation in the bright green of stocks, and then the differential. So again, there's in addition to the good return, you do get a little bit of accounting magic from private equity. And we've been talking, and this is relevant because, that's a theoretical thing. Maybe these are more risky than what the standard deviation is showing you, but you do get that benefit. And if you want to have less equity volatility and equity return, it's not a bad way to go. Page 18 is our last slide before the wrap up. So if you're going to implement, what's the manager universe like through fund to fund? There's about 100 people or firms out there that are holding themselves out as partnership pickers. Yeah, I'll build you a portfolio of partnerships. For what you're looking for, which is all strategies and global, so U.S., non-U.S., even emerging markets perhaps. There's probably about 15 really successful institutional firms we would focus you towards. We would work with staff to kind of go through each and every one of those. And maybe not send out questionnaires to all of them, maybe send out questionnaires to about half. So a good spectrum of your choices, the better ones, which is better returns, lower fees, essentially. Then we would, come back, do qualitative, quantitative analysis on them. You're a California fund, we would make sure that they could get you your fees that you need to put into CAFR because of the new California law. You have to disclose your private equity fees, so they would you would outsource that to give you information on that. Returns, fee calculations, look at all the types of things at the bottom here that you would look at for a public equity manager. What's your organization, how are you staffed, how many senior people do you have, how many junior, what's your back office like, what's your strategy approach, how's that different from some of the other candidates, all those types of things. Who's your investor base, is it diversified, do you know how to work with public funds? So that would be it. There would be strategic planning. This is really the manager search portion. We would put you up on a model to say, okay, well, if you're going to try to get to X% target, how much should you be committing each year so that you dollar cost average to get to that target in a timely manner, but don't overshoot the target by trying to force money into the marketplace.
Thank you.
Questions?
I have a question. So, can I find these 15 firms in Petal?
No, they won't be in PEP.
We can talk about that offline. PEP is our performance evaluation software. It essentially gives James and Robert direct access to our database. So you can create your own charts and geek out on the numbers, and that's what we like to do. So anyone that wants to get in there with us.
Yeah, as a private asset class, as with a lot of the real estate managers too, they don't go into PEP because they don't calculate their returns in time-weighted space, and PEP is a time-weighted.
It's different.
Yeah.
Well, thank you very much. It's like, we got a lot of information, and like you said at the beginning, we don't have to make a decision.
Yes. So thank you for sticking with us through all that. We know it is a lot of information, but it doesn't sound like there's any inclination to veer off course in terms of the plan for the asset liability studies. And from there, we'll look at each individual asset class from an implementation standpoint.
Thank you.
Thank you for your time.
Thank you.
We also have the monthly report, which we didn't get up on the agenda website stuff, and that's my fault. So Judy's got these. I don't know if you want to top line it for us, Claire, in about
Sure, just briefly.
42 seconds.
In 42 seconds, May was a negative return. We've seen certainly very strong positive returns year to date, but increased volatility through the fourth quarter, obviously, bounced back in the first quarter, and then April was positive, May was negative, and now we're seeing positive returns out of June as well. So we'll deep dive into returns for the second quarter at our next meeting.
You got 22 seconds to spare.
August, we'll do quarterly, not July.
Right, sorry.
Or I guess the next time
The next
you're
one
here.
that we'll be at.
Yes.
Correct, yeah.
Okay.
One thing that struck me about performance through May is that you all look at the fiscal year-to-date returns. So I talk about calendar year-to-date, and the S&P's up 15%, international markets up 11-12% year-to-date through I think last Friday. Bonds are up 4%, I believe, calendar year-to-date. Fiscal year-to-date, you're just about flat. Through the end of May, returns were down about 80 basis points. So another perspective to keep on as we slice the different time periods. When I look back over your fiscal year-to-date returns, you're either the top dot or the bottom, and you've been at the top for a long time. 2018 was a low return year for you, and but from a fiscal year-to-date perspective, you're just about flat on absolute terms.
Okay.
All right.
That was probably more than 22 seconds.
It was.
I'll give it back to you next time. Yeah.
All right.
All right.
Thank you.
Thank you.
Thank you.
Thank you very much.
Then we'll take a break.
Yes.
Back at 11?
Yes.
Oh,
Okay.
Go ahead.
Sorry.
No. I know.
Jerry's leaving.
She
She'll run
has
out
a-
the door.
I have
To James.
I have
That
James,
coffee.
right? Okay,
I can't switch this chair.
so now
Yeah, you think I got it, thank you.
we're back.
Yes.
And we're ready for item 4, discussion regarding fiscal year 2019 third quarter budget update.
Thank you, Madam Chair. Trustees, you have the quarterly budget update before you. I will just touch on Schedule 1B and 2B very, very quickly. Looking at the total expenses relative to last year, so I'm at the bottom of Schedule 1B. We are above prior year total expenses. Wait, am I on the right schedule? Yes. Above last year by 1.3% in total expenses. In administrative expenses, we are above prior year by 11.7%.
Keyboard.
And then versus budget, we are under budget by 11% on Schedule 2B and under budget by 13.7% on administrative expenses. The largest part of the administrative expenses is the contracts item. Nope, that's not there. Personnel, there, it's split across a bunch of different areas. So I'd be happy to try to answer any questions you may have. Normally, this is a report that would come to you in May. We're just a little behind this year because of the transition in the financial investment officer position. So.
I think we're doing really well because at least we have one.
A financial investment officer or a budget update?
A budget
Yes.
update and
Both. Good point.
Agreed.
Yeah, that was nearly seamless. I mean, there's lots of times there'll be a vacancy.
Oh, yeah.
And it never gets filled
Yeah.
for months.
yes, happens a lot.
Yes, that was not going to happen here because the work was going to fall to me, so. And I knew that was a recipe for disaster, so needed someone who knew what they're doing to take it over. So,
Okay. So item 6, we're ready for item 6. Do we have item 5?
5? Item
Oh,
5.
5, I can't read. Discussion regarding fiscal year 2019 budget projection.
Thank you, Madam Chair. Trustees, you have this, the schedules as well. And I'll remind you, this typically is not an item that's presented to the board on its own. It is based on the Q3 budget update, and then we project the budget and do a comparison for the budget proposal is typically how this happens. Since the Q3 budget update was delayed, we didn't have the budget projection when we put forth the budget proposal. I'm saying budget a lot. So I wanted to bring that back to you. You have the schedules and the memo there. I'd be happy to answer any questions you may have.
So administrative expenses are quite a bit below.
Which schedule are you
I'm looking at administrative.
on? Schedule 2?
Yeah.
Yes, we are well below budget on the administrative expenses. And in this case, and this is the projection for the full fiscal year, the largest driver here is the contracts item. We are over $100,000. We anticipate being $100,000 below budget. I'll remind the board that we included dollars, the $100,000 figure in the contracts item, anticipating a risk analysis that got put off because of other priorities on the board work plan. We do expect to come back to that at some point, but that's not going to get done this year, and it's not included in the budget for next year either. But it's just a shifting of priorities. In the personnel line, we're also anticipating being below budget by $54,000. That's another significant variation there. There's a number of factors taking place there. There was the health insurance holiday that was for the last 3 months of calendar year 18. Premiums did not have to be paid there, so that brought us in below budget. We've also had, there was a vacancy in the financial investment officer position for a period of time. That contributed to that. And then we have the overtime that was budgeted in for the full fiscal year. We didn't use any of that for the first 3 quarters, so that those are the 3 major drivers of the deviation in the personnel expense line.
Are there any other questions, or? So it's okay to move on to number 6?
Thank you, Madam Chair. Trustees, you have the administrative report before you. 3 items there. I'm going to jump to the travel policy and assume you've all read the memo and you're aware of that issue. As things develop, when the county resolves their issues, I'll come back to you with an amended travel policy as appropriate. There's a legislative update, and then I wanted to save the potential public safety power shutoff item, as I anticipate the possibility of discussion on that. Just want to remind the board that it was 9 months ago we talked about the possibility of adding a generator at our building here, and the board decided at that time that it didn't seem justified. With the new development of the potential for public safety power shutoffs, I thought maybe we should reconsider, we should at least return to that issue, because there is the very real possibility. While we are in the city of Ukiah, if PG&E shuts off power, there is only one transmission line, wow, I cannot word it today, into the valley, and if PG&E shuts off power, our office building will be without power.
But so will everything will be without, the whole city will be down, the whole county will be down, everything will be down.
I have an email into the executive office to try to understand if they have backup generators at the admin building, and if they'll be functioning, and could we operate from there, but.
So I believe so, yeah, there's a number of county buildings that have backup generators, and I think they're also kind of revamping, updating some of the equipment. And another strategy I've heard some people talk about, if they don't have the money for a generator, I guess there's a way of actually retrofitting the power to your building so that you can, it's sort of plug-in ready for a generator. So some people have talked about retrofitting buildings in that, institutional buildings like that. So at least if there is a power shut and they have access to a generator, they could just deliver it to operate for a few hours or for a few days. And since this is something that PG is going to be doing, I think there may be a request going into them pretty soon saying, well, then we want you to bring in generators for these buildings.
That's pretty immediate, right?
Yeah.
Like
So, but
tomorrow.
I'm just saying that's why I just was in a meeting recently, and that was one of our thoughts was like, let's put a request to PG that we want them to bring in generators for these buildings that we've retrofitted to be plug-in ready. So I don't know. It's like if we think that'll happen, then maybe we just come up with a minor expense to retrofit our building. Otherwise, if we don't think that's going to happen, then we bring it, pay for a generator. But I guess that's the pros and the cons of
Pros and the cons, yes. And, with our, in our business continuity plan, if our systems are down, if it's because of a power outage or whatever, our primary off-site functioning is at the county administration center. I need to get connected with the CEO's office to make sure we understand exactly what their plans are, and would we be able to operate from there for a period of days. I also need to think about what that means for our tenant. And we have some responsibilities there, I'm sure.
We don't have any responsibility.
Yeah.
Yeah, I have a comment.
Well,
Oh, Richard was first.
Let them buy their own
So
generator.
tonight at 6 PM at the Ukiah City Council meeting, PG&E will be doing a presentation on this. And the city does have its own game plan, that'll be discussed as well. I was at a meeting where they actually said there was 2 lines in which if they both get shut off, they both get shut off. And so I think if any of you are interested in hearing what PG&E's specific plans are,
That's good to know.
it's 6 PM tonight, it's the first thing on the agenda at City Hall. And part of this also is basically political positioning, very much so. And because if I attended a gathering of city managers that talked about, well, heck, you could shut the county down. You can't shut the police department or the fire department down. What about Safeway? What about Rayleigh's? I mean, what about the hospital? So these are the places that are important. I mean, we could go to the county and work. You could have a battery backup, a large bank for computers and sit by the windows and work here for light. I mean, it's truly, this is not a joke. This is the kind of stuff people are talking about. The investment of massive generators, prices of generators are going up 20 to 25% now
Surprise.
in California. Surprise, surprise. But I think, starting point is getting real information.
You got a theoretical fire on one hand, you got dead people in the streets because they turn off the power. This is not gonna last.
Well, and plus, what is
People will
it?
die, if they turn off the power, people will die.
If it's 110, for sure.
And the economy, the local economy, the manufacturing facilities, the whatever. I mean, it's a game of chicken in a way. Part of it could be real. But, go ahead.
I think if anyone goes tonight, I was told that PG&E has said that they will need to recheck every single gas outlet and whatever if the power goes down, and that added to its being off for half a day or a day, they're talking about 6 and 7 and 8 days to check everything. So that's the kind of thing they ought to be pinned on is tonight, I think.
And the surge in power that's gonna blow up some people's computers.
Yeah.
So this is, I think it's all positioning just so that they can raise power rates through the sky to cover what they need to do to make sure that the power lines are clear, which is gonna cost a lot of money, and we have to pay for it.
Yeah.
Sharon?
So you should probably be involved. We're gonna have a meeting, auditors, us, the treasurer, tax collector, CEO's office, with the financial piece to this, because we have to be able to have the ability to, there's some things we're talking about doing in our office. We send out auto wires, different things like that. We're not gonna wait till the last day to do them anymore. We're gonna probably send them out 2 and 3 days early, so we don't get to where we have, just during this period right here we're in. But just to make sure that we're thinking of everything. I know there's things in place where Bank of America will automatically send the last file from the last payroll if another one can't get done. And then you just have to correct all those adjustments. So there are things in place to deal with that, but the financial piece is something that we are going to be meeting, my guess is, I think, next week on, so you probably need to definitely be involved with that as well, so.
Is my refund in the mail?
Do you have a refund coming?
And we do have, a series of contingencies in our business continuity plan. Before we get to the asking Bank of America to run last month's file, we also have Pension Gold can pick up and run our retirement benefits for us if we need them to. And that's after we've tried to operate from another county facility or have everyone work remotely to do what needs to be done. So we've got belts and suspenders and backups on backups for getting the retirement benefits cut every month. So I just put this on here to see if what the pleasure of the board is. Do we want to revisit this issue or wait and see? Or, I mean, I still don't have information from the county as far as what their plans are and what our abilities could be.
Maybe agendize something at the next meeting, because after, I mean, that was good information, what Richard just said. I mean, by then, it feels like it's supposed to be later. Is that what you've kind of heard? It's more like, I mean, do they think this is gonna happen like next week or the week after, or more like August, September, October?
They already shut off now, but they're.
But it was quick, right? Yeah, but every,
It was 3 days. And then-
so,
My anticipation here is if the board wants more information, I will go get that. If you want proposals, I can start working on that.
I vote for a generator.
I'm not asking for a vote.
I vote for investigation of solar and battery rather than a generator.
I haven't looked at the Farmer's Almanac, because I have no idea what the next week will bring, but, you know, it could be as close as next week, supposedly.
Right.
I mean, if it's next week, there's nothing that we're going to do.
anyway,
So-
right.
so-
I mean, we're going to be like everyone else in Ukiah.
Solar, that might be a really good idea. You know, we could probably get somebody to do it all and rent it to us.
We just got a proposal that would do this office, and it was 20,000. We don't get tax rebates, but.
Well, that's why I say get
Yeah.
somebody else to do it,
So
they get the tax.
my
rebate.
question is, have you discussed with anybody at the county where you're gonna plop these people down in their building during the chaos?
No, we've not had those
I
discussions
think that's
yet.
the first discussion.
You mean
had.
Suite A?
Well, wherever
Or-
you might go to the county facility to do your work,
Oh,
who's gonna let you in their door and give you a desk or two? I think,
Well, there's the,
The buzzer doesn't
computers and
Okay,
actually,
well, there you go.
we've been in that situation.
okay, great, thank you for that answer.
August.
What'd you say?
Glad to know somebody's on it.
IS conference room has many computers, they may have a few vacancies there for us.
I don't know if there's generators.
And there's the
Yeah, that's
training
the
room,
question.
the
Right.
highest
So-
training room as well.
Your plan's only as good as the county's generation of the server back, so we can only
Right.
do so much, but if the Munis or those programs aren't up, then, you know, we have plans to remote in from out of the area if we have to,
Yeah.
where there is power, but yeah, if the county's down and they don't have anything, then you're not doing anything anyway, you have no place for them to go.
Okay, well,
Yeah.
that's,
Unless Pension Gold is on a different server, like you said, somewhere else.
Pension Gold is not on the county server.
Who's just
Okay,
not
so-
gonna
It's all
do it?
web-based
Yeah.
interface.
Yeah, better here then.
Generator
Yeah.
company.
Yeah, as long as we can get to the internet, we can access Pension Gold.
Yeah.
So,
We buy stock in generator companies.
Yeah, different structure.
Private equity.
so if I've understood the direction of the board is you want more information, and come back and let's have more discussions once I have more information.
And maybe it'll be 110 on that day.
well,
How much?
is that the pleasure of the board?
I think one of the things to find out is what would be the minimum generator capacity we need to run, is it one computer, two computer, you know? Well, because like on my house, I have a generator this big that runs half my, it
We're all going to
runs
Lee's
the
house.
refrigerator and the computers. And so, I mean, I don't have a big one, so.
the AC is the issue.
That is-
If it's 110 outside and the power's off,
Yeah.
you'll last an hour in here.
Yeah.
So, that's the issue.
Because there was only, in this half of the building, there was only one window that opens.
Yeah.
You wouldn't want to open.
No, you wouldn't.
It's not gonna
Yeah.
matter.
So you open them at night and close them.
Well, and then the other issue is all the county employees are, workers. We're all have to go help. They'll open up the EOC, right?
First response.
Yeah, I mean, we're all emergency workers. So
Oh, yeah.
it's a whole, yeah, I mean, there's a bunch of stuff going on.
Sorry, Richard lives on the coast.
What do you? Show up and
You were stressing.
fan their face for us?
Yeah, I have no idea.
So is
Well, you're
the
right.
direction of the board to give?
Gather information and come back for further discussion.
Think about it.
And talk with us next week and meet with us on the financial piece.
Okay.
Yeah.
Just let me know when. Very good. That's all I have unless there are any questions.
Okay, and we have general board member discussion. Is there any discussion besides what we just discussed? Or in addition to? Okay, so then we'll go into closed session.
Yes.
Forgot about that.
So,
We have 2 items on the closed session agenda.
okay, yes. And the first one, we have to.
Yes, we will close the door.
Okay, I have one question before we close up, I'm sorry. So, I cannot remember the legislation, but it was the legislation passed last year that required all JPAs in California to have a plan to pay their unfunded liabilities for retirement based on dissolution of the JPA.
Yeah, that was a big.
So, and we might be worthy to get a report how that affects MSERA and its members. The county is a member of a number of JPAs. And so I don't know if the courts are, I don't know if the cemetery district is, but I know working and where the board is talking about this through CalPERS is a big deal.
I'm not aware that that's an impact on Sarah at all, but happy to check.
At least for its sponsors it is.
None of the other
And
districts.
MSERA should be aware of it.
They're not, so none of our plan sponsors are JPAs, but the county may participate in some JPAs, and if there are employees in those JPAs, are they members here, is the question.
And current law has CalPERS being very active as making demands if you don't take action for a plan, how your JP might be dissolved and your liabilities paid. And so if we're in the county's in a JPA with CalPERS members, it's got a problem. And we may have a problem, I don't know.
Well, if the members are in CalPERS, that's a county problem, that's not an MSERA problem.
Right.
Okay,
I like your analysis.
maybe this is only for
No,
one
I
set of
think that's
years
right.
in the room.
I don't understand your question, and I like his analysis.
If you're comfortable with that, we can invest in anybody that walks in the door.
I mean, I understand the question, and I think it is something that we should look at and try to understand. And if there are any members in our system that are employed by a JPA but are wrapped up in a county employee, we need to be aware of that. But we can also reach out to the county and have some conversations about that legislation and see if there's anything.
Well, sure.
We can educate plan sponsors that could be impacted by that if they're not already aware.
Okay, and what impact it may have on non-CalPERS retirement agency
Right.
or the sponsors of it.
Right. It's on the list.
I think it's down, sure.
Okay, can I move along?
Okay.
We're ready to go into closed session?
Network's down in the county. Something's down, we can't access the documents.
Are you serious?
Yeah.
The
I thought you were
the Wi-Fi seems to be working intermittently at this point in time. If you need to log back in, you may want to try the public library Wi-Fi connection. That seems to be more reliable.
Are there documents for the?
No, I don't know.
You won't need them for the disability case. If there are some for the performance evaluation,
No.
if there aren't, then you don't worry
All
about it.
right, Scott,
Okay.
we're closing the door.
then there's no reportable action.
Judy, this is for you.
Okay, so
I move that we adjourn.
is there a second?
So moved.
So seconded.
All those in favor?
Aye.
Okay, we're officially adjourned at 12:00.
All right, thank you.
That was so good.
A minute late.
Is that your
Oh,
laptop?
you guys all
You know what, I feel like my problem is,
Jeff's
black.
back. Jeff,
That's
you
why I
got it.
got that green one.